and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here.
So today we're diving into a really interesting topic, PropStream versus REI/KIT. I mean, if you're looking to invest in real estate, having the right data tools can make all the difference, right?
For sure, Sarah. It's like having a map when you're going on a road trip. You wouldn't want to get lost, especially when you're trying to build wealth.
Exactly. We'll be comparing these two platforms, talking about their features, how they can help you find deals, and which one might be the best fit for you.
And we'll also touch on some practical tips for using these tools effectively so you can really maximize your investment potential.
Plus, we'll share some personal experiences and insights from our own journeys in real estate, things that have worked for us, and, maybe some mistakes we've learned from along the way.
That's right. It's all about learning from each other and finding what works best for you, especially as you navigate this exciting journey.
So if you're ready to explore the world of real estate data tools and how they can enhance your investment strategy, let's jump right in.
Sounds great. Let's get started. Sarah, when we talk about tools like PropStream and REI/KIT, it's not just about crunching numbers or pulling up data. It's really about understanding the bigger picture, especially for folks over 40 who are thinking about their financial future.
Absolutely, Mike. I mean, many people in that age group are starting to seriously consider retirement, right? The timeline for retirement is getting closer, and they want to make sure their investments are solid.
Exactly. And with inflation being what it is these days, it's crucial to have strategies that not only protect wealth, but also grow it. I've seen investors in their 40s and 50s really take a proactive approach to real estate, knowing that property can be a hedge against inflation.
Right, because as prices rise, so do rents and property values, which can really help maintain purchasing power. I recall a client, let's call him Tom. He started investing in his late 40s. He bought a couple of rental properties in a growing neighborhood.
Tom's story is a great example. He was really motivated by the idea of creating a passive income stream for his retirement. The cash flow from those rentals has made a world of difference for him, especially as he's now nearing retirement age.
And he didn't just buy based on a hunch, right? He used tools like PropStream to analyze market trends, look at property values, and even assess rental demand in different areas. It gave him the confidence to make informed decisions.
That's the key. Knowing where to invest and how to analyze the data can prevent costly mistakes. For someone like Tom, it was about ensuring that he wasn't just throwing money into a property, but rather investing in a location that would yield returns.
And let's not forget about family considerations. Many people over 40 are also thinking about wealth transfer to their children or grandchildren. They want to leave behind something substantial. Not just a financial legacy, but a property that can appreciate over time.
Exactly. I've seen many investors create a plan where they buy properties not just for themselves, but for future generations. They view real estate as a way to build intergenerational wealth. I remember another client, let's call her Linda.
Oh, I think I know Linda's story. She bought a duplex with the intention of living in one unit and renting out the other, right?
You got it. Linda's approach was really smart. She used the rental income to help cover her mortgage, allowing her to live more comfortably. But what she really loved was knowing that, eventually, she could pass down that property to her kids.
And think about the emotional side of that. It's not just about the numbers, but the sense of security it brings. Knowing there's a tangible asset that can provide for your family, that must be a huge relief for her.
Absolutely. Property can be a source of security and stability, especially in uncertain economic times. The more people can focus on that emotional aspect of investing, the more they can see the value in it, beyond just the financial return.
And with the current economic trends, it makes sense to be strategic. Interest rates are fluctuating, and the market is shifting. Having the right data tools helps investors stay ahead of these changes.
For sure. And it's not just about finding good deals, but also about knowing when to hold or when to sell. I've seen investors who've used PropStream to track market shifts and adjust their portfolios accordingly, maximizing their returns.
Yeah, like when the market was cooling off a bit, some of them chose to hold on to their properties rather than sell at a loss. They understood that real estate is often a long-term game.
Right, and that's a crucial mindset to have. It's not just about immediate gains, It's about building something sustainable over time. Like one investor I worked with, Dave, who focused on multifamily properties.
Multifamily can be a great strategy.
Definitely. Dave had a clear strategy to acquire properties in up-and-coming areas. He used REI/KIT to analyze demographics, potential rental income, and even neighborhood trends. It gave him the confidence to invest in properties that he knew would appreciate.
And that kind of research is invaluable. It's not just about numbers. It's about understanding the community, the potential for growth, and how all of that fits into his retirement plan.
Exactly. He was also very aware of the emotional aspects, like creating a sense of community for his tenants. He believed that happy tenants lead to longer leases, which in turn meant more stability for him.
That's such a great point. It's about building relationships, not just transactions. And tools like PropStream and REI/KIT can help foster that understanding by providing insights into tenant needs and preferences.
Well said. And, as we look at these strategies, it's clear that understanding the data is just the first step. The real magic happens when investors combine that knowledge with their personal goals and values.
Absolutely. It's about aligning those goals with the right strategies and tools so they can build something meaningful.
And now that we've laid out why this matters, let's dive into some core strategies that can help listeners leverage these tools effectively. So Sarah, let's dive into some of the core strategies and rules of thumb that can really help our listeners when evaluating properties.
Yeah, that sounds great. I mean, having those straightforward guidelines makes it easier, especially for someone just starting out. Where do you think we should begin?
Well, a classic one is the 1% rule. It's pretty straightforward. If you're looking at a rental property, the monthly rent should ideally be 1% of the purchase price. So, if you buy a property for $200,000, you'd want to see it renting for around $2,000 a month.
Right? That's a simple way to gauge whether the cash flow might be worth it, isn't it?
Exactly. But, it's not the end-all be-all. Sometimes, in markets where prices are high, you might not hit that 1% mark, but if the appreciation potential is strong, it could still be a solid investment.
Good point. And then there's the 50% rule, which is another quick way to assess potential profitability, right?
Yes, the 50% rule suggests that you should expect to spend about 50% of your rental income on expenses, like maintenance, property management, taxes, and vacancies. So if you're renting that $200,000 property for $2,000 a month, you'd budget about $1,000 for those costs.
That makes sense. And it helps to keep expectations realistic. So if you're netting around $1,000 after expenses, you're looking at a decent cash flow, especially if you've got a good mortgage rate.
Absolutely. And understanding your financing options is crucial too. Traditional mortgages, FHA loans, and even hard money loans can all play a role depending on your strategy. For example, FHA loans are great for first-time buyers because they require a lower down payment, right?
Yes, and that can really help someone who's just starting to build their portfolio. But I guess it's important to remember the trade-offs like private mortgage insurance and possibly higher interest rates.
For sure. And speaking of interest rates, I'd recommend keeping an eye on current market trends. Rates can really affect your cash flow calculations. If you can snag a lower rate, it can make a big difference in your overall investment.
Oh, definitely. And then there's the importance of knowing your property types. Single-family homes, multifamily units, and commercial properties all have different dynamics, don't they?
Right. Single-family homes tend to be more stable in terms of tenant turnover, while multifamily properties can offer better cash flow potential, but they also come with more management requirements. You really have to consider what fits your lifestyle and investment goals.
Exactly. And if someone is looking at multifamily properties, they should be aware of the economies of scale. Like if you have one roof over multiple units, your maintenance costs can be lower on a per-unit basis.
Exactly. And then there's the cap rate, short for capitalization rate. It's a way to estimate the return on an investment property. You calculate it by taking the net operating income and dividing it by the property's purchase price, or current market value.
So, if you buy a property for $300,000 and your net operating income is $30,000, your cap rate would be 10%. That's a solid return, right?
Yes, it is. A higher cap rate typically indicates a better investment, but you have to be careful. Sometimes, a high cap rate might mean the property is in a less desirable location, or needs significant repairs.
That's a good reminder. You really have to look at the whole picture, including the neighborhood and potential for appreciation. And I think a deal evaluation checklist can help with that too.
Absolutely. A checklist might include things like, what's the market value? What are the comparable sales in the area? Are there any immediate repairs needed? And, of course, what's the potential for cash flow?
Love that. And I think it's also important to consider the long-term play. Like, is the area developing? Are there upcoming amenities that could boost property values?
Yes! Location is key. Being aware of future developments, like new schools or shopping centers, can really impact your investment positively. But you also want to be cautious. Don't get swept up in hype without doing your due diligence.
Right. Due diligence is essential. And what about financing within specific markets? Different areas might have different lending criteria or opportunities.
Great point. If you're investing in a hot market, lenders might be more cautious, but in emerging markets, they could be more flexible. It's important to build relationships with local lenders who understand their market well.
Networking can really pay off in that regard. And then, of course, there's the importance of having an exit strategy, too. What happens if things don't go as planned?
Exactly. Having a solid exit strategy, whether it's selling, refinancing, or holding for the long term, is crucial. You want to be prepared for various scenarios, especially in fluctuating markets.
Totally. And as we talk about all these strategies and rules, it's easy to get excited. But we should also touch on some common pitfalls that people might encounter.
Yes. Pitfalls can really derail even the best laid plans, so it's important to be aware of them. Let's explore some of those next. You know, Sarah, one of the big pitfalls I see with investors, especially those just starting out, is over-leveraging. It's tempting, right? You see a great property, and you think, if I can just stretch a bit more, I can get it.
Yeah, I totally get that. It can feel like you're missing out if you don't jump in with both feet. But what happens when you over-leverage?
Well, it can lead to some serious financial stress. I remember a client of mine, let's call him Tom. He bought a multifamily unit with a very high loan-to-value ratio. The rents were decent, but he didn't account for the inevitable repairs and vacancies.
Oh no, that sounds rough. What did he end up facing?
Right? So he ended up with some bad tenants who didn't pay on time, and a few months into ownership, he was hit with unexpected maintenance costs. His cash flow took a nosedive, and he was scrambling to cover the mortgage.
That must have been so stressful for him.
Exactly. If he had left a buffer in his budget or invested in a property with a lower loan-to-value ratio, he might have been in a much better position.
So what's the takeaway there?
Always, always assess your cash flow realistically. Don't just rely on the property's projected income. Consider those hidden costs, maintenance, management fees, and potential vacancies.
That makes total sense. What about bad tenants? That's another common pitfall, right?
Absolutely. I think a lot of new investors underestimate the importance of tenant screening. A friend of mine, let's call her Lisa, thought she could save money by not doing thorough background checks.
Yikes! What happened with Lisa?
She ended up with a tenant who had a history of late payments and, well, let's just say they didn't treat the place very well. After a few months, she was dealing with property damage and late rent.
Wow. That must have been a huge headache for her.
It was. She had to go through the eviction process, which took time and money. If she had taken the time to vet her tenants properly, checking their credit, rental history, and even getting references, she could have avoided that situation.
So what should someone look for when screening tenants?
Look for red flags, like inconsistent employment, previous evictions, or rental history that doesn't add up. And you know, it's worth investing in a good property management service if you're unsure about handling it yourself.
That's solid advice. Now, what about ignoring cash flow? That seems like a biggie.
Right? It's crucial, especially for investors over 40 who might be relying on this income for retirement. I've seen investors get caught up in the property's appreciation potential without realizing that cash flow is the lifeblood of their investment.
Can you give an example?
Sure. There was a couple, let's call them Jim and Kathy. They bought a property in a rapidly appreciating neighborhood, thinking they'd sell it for a big profit down the line. But they didn't calculate the monthly expenses properly.
And what happened?
They were essentially losing money each month because their expenses were higher than their rental income. When it came time to sell, the market had dipped slightly, and they had to unload the property at a loss.
That's such a tough lesson. How can someone avoid that mistake?
Always prioritize cash flow. Do your homework on what properties in the area are truly renting for, and don't just assume appreciation will save you.
It sounds like timing the market is another common pitfall, too.
Oh, definitely. Trying to time the market perfectly is like trying to catch lightning in a bottle. I've seen investors wait for the perfect moment, and by the time they're ready, prices have gone up.
Right? And then they miss out on great opportunities.
Exactly. I had a client who waited for what they thought was a dip in the market, but when they finally pulled the trigger, prices had surged. They ended up paying way more than if they had bought earlier.
So what's the best approach to avoid that?
Focus on long-term strategies rather than short-term gains. Real estate is a marathon, not a sprint. If you find a property that fits your investment criteria, don't hesitate too long.
That's a good perspective. Now, hidden costs. What should investors be aware of there?
Hidden costs can really catch you off guard. I had another client, let's call her Brenda. She purchased a rental property but overlooked things like property taxes, insurance, and HOA fees.
What was the outcome for her?
She quickly realized her cash flow was significantly lower than expected. Those additional costs added up, and she was left with almost nothing after expenses.
That sounds frustrating.
It was. The key here is to do a comprehensive analysis before buying. Look at all potential costs, not just the mortgage payment.
What advice would you give someone to spot those red flags early?
Always ask for a detailed breakdown of expenses from the seller and do your own research. Talk to other investors in the area and don't be afraid to ask questions.
It sounds like communication is key.
Absolutely. Being proactive about understanding the market and your potential investment can save you a lot of heartache down the road.
So if someone finds themselves in one of these situations, what are some next steps they can take to recover or avoid these pitfalls in the future?
Well, the first step is to reassess your financial strategy. If you're over-leveraged, consider refinancing or selling off a property to reduce your debt. If you've got bad tenants, it might be time to consult a property manager or even look at eviction options if necessary.
And keeping an eye on cash flow and hidden costs, right?
Exactly. Always keep those front of mind. Set up a budget that includes all potential expenses and stick to it. That way, you can make informed decisions, no matter what the market is doing.
Such practical advice, Mike. Thanks for breaking all of this down.
My pleasure, Sarah. It's all about learning from these experiences and moving forward. All right, so let's dive into some immediate steps folks can take right now to get started with these data tools.
Yeah, I think it's really important for listeners to have practical takeaways they can implement today.
Exactly. So first off, if you're looking at PropStream or REI/Kit, I'd suggest signing up for their free trial if they offer one. It's a great way to get a feel for their features without committing just yet.
That makes sense. And while you're exploring those platforms, you can also check out other tools like Zillow for property valuations. It's super user-friendly and can give you a quick idea of property values in your area.
Right! And then there's also the Bigger Pockets calculator. If you're analyzing potential deals, this tool is invaluable. You can play around with different scenarios, which helps you understand your potential returns.
Oh, and don't forget about DealCheck. It's another excellent app for analyzing rental properties. You can easily compare multiple properties and see which one stands out.
Absolutely. And if you're looking to get a sense of rental prices in your target area, Rentometer is a fantastic tool. You just input the address, and it gives you a report on rental rates.
That's really helpful. And for those who might have access to local MLS, that's another goldmine for data. You can find detailed information on properties that might not even be listed elsewhere.
For sure. And remember, it's all about getting comfortable with the data. Start small, maybe analyze one deal a week. It doesn't have to be overwhelming.
Yeah, I love that idea. And joining a local real estate meetup can also be beneficial. You'll connect with like-minded individuals and share insights, which can really accelerate your learning.
Right, it can be super motivating to have that community support. And speaking of learning, there are some great books out there too.
Oh, definitely. Any recommendations?
Well, the book on rental property investing by Brandon Turner is a classic. It covers the fundamentals really well and is super approachable.
That's a great one. I'd also suggest Real Estate Investing for Dummies if you want something that breaks down the basics clearly.
Yeah, that's a solid choice too. And don't overlook podcasts. There are so many out there that dive deep into real estate investing. Bigger Pockets, of course, is one of my favorites.
Same here. And there's the Real Estate Guys radio show, which is really engaging and covers a wide range of topics.
It's also important to develop habits that help you stay consistent. Even just dedicating 30 minutes a day to learning or analyzing properties can add up quickly.
Absolutely. That consistency is key. Maybe even set a goal for yourself, like reviewing a few listings each week or reaching out to one new contact in the industry.
Yeah, and don't forget to keep a journal of your findings. It can be really helpful to track your progress, notes, and insights.
That's a great idea. And as you get more comfortable with the tools and the data, you'll start to see trends and patterns that can inform your investing decisions.
Exactly. And remember, it's perfectly fine to start where you are. You don't need to have everything figured out at once. Just take it one step at a time.
So true. And with these tools and tips, listeners can really start building their knowledge base and confidence in real estate investing.
Well said. So those are some practical first steps. Now let's bring this all together. So to wrap things up, I think we really nailed some key points, didn't we?
Absolutely. One of the big takeaways was the importance of having solid data tools, right? PropStream and REI/Kit both bring something unique to the table.
Yeah, and, understanding how to leverage those tools can really set you apart in this market. PropStream offers extensive property data, which is great for detailed analysis.
Right, and then REI/Kit shines with its user-friendly interface. It's designed to be intuitive, which honestly can save you a lot of time when you're starting out.
Exactly. And let's not forget about the community features in REI/Kit. They can really help you connect with other investors and share insights.
For sure. Networking is so crucial, especially when you're over 40 and looking to build a solid portfolio. It's about learning from others, too.
Well said. And I think the final takeaway is that investing in these tools isn't just about the numbers. It's about gaining confidence in your decisions.
Yes, confidence is key. When you feel empowered with the right information, it really helps you make those bold moves towards building wealth.
Absolutely. And remember, folks, real estate is a journey. It's about taking those steps one at a time and watching your investments grow over the years.
So if you found value in today's discussion, we'd love for you to like and subscribe. Also, drop a comment sharing your biggest takeaway or any questions you have.
And don't forget to share this episode with someone over 40 who's considering investing in property. It could really help them get started.
Next time, we'll dive into something exciting. ChatGPT for real estate marketing. You won't want to miss it.
Yeah, that's going to be fun.
Thanks for joining us today. We appreciate each and every one of you.
Take care, everyone.
Bye for now.